Are interest rates high enough to start tamping down inflation? Should the Fed stop hiking? Joining me now, Stifel CEO Ron Kruszewski. Ron, thanks so much for coming back on the show.
Pleasure to be here.
I got to say, when you were on a year ago, you told us that you were concerned that COVID stimulus and supply chain problems could cause an inflation spike. Well, check that box. And you also said recession was inevitable. We seem to be close. We'll see where that goes. But more recently, you've been saying that the Fed should actually ease back a little bit and not hike so aggressively. Tell us your thoughts there.
Well, first of all, we did talk a year ago. We have to look at what caused inflation, and that was just a whole bunch of stimulus, reopening of the economy, and supply chain disruptions. And it's taken us 15 months to get to what I think is peak inflation. Today, if you look at the last quarter annualized, inflation's 2%. Wages are trending downward according to the Atlanta Fed. So I already believe that inflation is coming down. And I think one of the big risks to the market is that the Fed overdoes it.
The Fed has a long record of overdoing it on this particular issue. So where we are right now, I mean, obviously we don't know what the next hike will be for sure and after that. But do you think, what are your odds on a recession?
Well, as I said, it's inevitable. I don't think that at some point, obviously, but I don't think that we have to end in a recession if the Fed allows inflation to naturally come down. So I'll give you, if I was the policymaker, which I'm not, I certainly acknowledge that, but I actually think another 100 basis points get to, the low fours in the effective rate would allow inflation to come down and may allow for a soft landing. The markets today, or not today, that in general believe that the Fed will get to, say, the high fours, and I think that would be too much.
Gotcha. So what do you see as the market outlook for the coming months?
Well, it depends on, there's some risk. First of all, at the status quo, I believe this market is set up for a rally. There's been a lot of bad news, and I believe that investors can have a seasonal rally in the markets here. If you want to think about what to invest in, I would think cyclical stocks, growth tech, financials, even home builders could do well here. But there's risks to this scenario, too. As I said, the Fed overkill's a risk. No one's talking about the lack of liquidity in the bond market. That's a big risk, maybe kind of technical to be talking about here. But when you look at the lack of liquidity, a lot of the professionals realize that that's a problem. But I think the biggest risk is geopolitical. And that's obviously what's going on in Russia and Ukraine. That's what's going on maybe in the South China Sea. But in particular, December 5th. And what December 5th is where the G7 has said they will effectively cap prices on Russian oil. Now, I don't know about you. I've been in this business a long time. I have never seen price caps ever work.
Yeah, that is for sure. That is for sure. The liquidity point is interesting, too. I don't think people are aware of that issue, but on Wall Street, it's a big deal and could get worse. So it'll be interesting to see where that goes. I want to take this down to the retail level because you have a force of more than 2,000 financial advisors. 4 of them are top-ranked Barron's advisors. What are they hearing from clients right now? What are the big concerns?
I think it's a lot of the things I've been saying, but interestingly, the clients are okay with not trying to time a bottom because what they're doing is they're moving cash into what is a pretty good alternative yield. I mean, the 1 year's 4.60, and so clients, to the extent that they want to see how all this plays out, are very happy with just leaving money in a short-term treasury because that yield is so much higher than it was before. So I don't see clients in any way panicking or trying to sell out of this market.
Yeah, we haven't seen rates like that for a long time, and obviously they're dangerous in some ways, but it feels pretty good for savers. And if we do have that recession, well, you might get some capital gains in those bonds too.
Absolutely, and so our investors are, they're looking. They see the long-term benefits of the market. You know what I tell investors is I say you have to realize that the days of zero interest rates and 2% inflation are probably gone. We may get to 2% inflation, but we're not going to get back to zero rates.
Yeah, exactly. And this is more like normal. 0% was not normal. Ron Kruszewski, thanks very much.